Welcome, everybody, to this week's podcast. My name's Andrew Wilkinson. Joining me today, Steve Sears, columnist at Barron's, where he pens the striking price. Welcome, Steve. How are you?
Great to be with you, Andrew.
And also with me, my colleague, Steve Sosnick, Chief Market Strategist at Interactive Brokers. Welcome, Steve.
Great to see you, Andrew.
So we thought we'd talk a little bit about headline risk, very apropos these days. Investing's never easy, but post-election, there was a significant groundswell of optimism that tax cuts, deregulation would sustain a rally in US equities. However, despite that strong start to the year, the selling has been mounting. Let's start with Steve Sosnick, who used to remind me that under Trump 1.0, the biggest overnight fear he faced was so-called tweet risk at the time. Steve, admittedly very early in the Trump 2.0 administration, but why are there cracks in the so-called Trump trade, and how serious are they?
Andrew, for starters, I think the markets just got ahead of themselves. We were in this huge momentum-driven rally pretty much since October, November 20. And so the election occurred really as that rally was in full force. And so it was just an accelerant to the rally. And I think whereas instead of following the trend higher, we accelerated the trend to a new level. And I think we're just falling back into place because a lot of the stuff that the market viewed as priorities that they thought the administration would view as a priority have not necessarily been the same as the market's priorities. So it's a little bit of impatience. Now, to be fair, we're about 6 or 7 weeks in. We're not even halfway through the first 100 days, but it's pretty clear that there's other things on the administration's mind, at least in the initial phase. And I think a lot of it is considered disruptive. One of the goals was to bring the financial house into better order. And certainly there's been a lot of cutting at the government spending level, but it seems to be done with a chainsaw, as with the Elon Musk metaphor, rather than with a scalpel. I think that has the market a little unsettled. I think the budget talks, at least initially, do have the tax cuts that everybody's hoping for, but it undermines the government rationalizing the government's balance sheet idea, because the tax cuts may outweigh any potential savings from spending. And of course, you get the back and forth with tariffs, where we're taping this on Monday, the 3rd. The tariffs are supposed to go into full effect tomorrow, the 4th. They may or may not get held up. And I think I was just asked the question, why is the market not reacting worse to the tariffs? And that is because I think it's very much a wait and see. And we'll see whether they get implemented tomorrow morning, whether they get implemented after the speech to Congress. Again, remember that we're taping this on Monday, the 3rd, with the big speech happening and the tariff implementation all scheduled for the 4th.
I see you nodding in the background there as Steve Sosnick is talking. You've written and watched many bull and bear market. Who's currently in control?
Neither the bulls nor the bears. It's President Trump. As Steve said, to bring it to a slightly sharper point, intellectually and ethically, the way Trump behaves is at odds with the way the street behaves. Most traders, investors, deal makers, deal lawyers are just inclined to do the deal, make a trade. They're not necessarily interested in winning at the expense of wiping out the other guy. And so you're seeing the tariffs being bandied about as a foreign policy tool. And that foreign policy tool is disrupting the global economic system that's been in place since World War II, since the ashes of World War II. And so I don't believe the street has any way of comprehending President Trump's actions. One, the street is generally used to being mollycoddled by world leaders. Trump doesn't mollycoddle them. In fact, Trump behaves like a New York real estate mogul who is so big and so powerful that he can get whatever he wants to at the deal table and everyone will fall into place. The street just isn't used to anybody acting that way. Sure, we have very tough deal makers, but even during the toughest negotiation, everyone refers to the climactic moment when it seems that both sides are going to walk away before a deal is reached. I think Trump is actually willing to walk away from the deal table, and no one's used to that. As a result of that, there's no way to truly understand what he does. Now, I'll point this morning to yesterday's Truth Social post about crypto, right? So this gets to what Steve was saying. Everybody thought that Trump is a pro-market, pro-crypto president, which in fact he actually is, although he hasn't acted like one recently. Last night, he says we're going to put several of these cryptocurrencies in our strategic crypto reserve for the country. What happens? They all surge. Now they're giving back some of their gains after the ISM came out with the new orders. Slow down. But just as we're one tweet away from a sell-off, we're also one tweet away from a huge rally. And I've never met anybody in the markets who can handle that type of uncertainty.
Mhm.
That's my longest response to that question.
Steve Sosnick, I noticed a subtle change last week following NVIDIA earnings. There was a remarkably muted reaction after hours to earnings, which came in strong. And when the market opened on Thursday, it took a little bit of a back and forth, a bit of a churn, and then NVIDIA's stock price slipped and then dragged down all other major tech, just about. How much does artificial intelligence, NVIDIA, big tech matter to the overall tone? And how much of risk are we at for weakening sentiment?
I think we are at risk for weakening sentiment because this whole really the market is predicated on the AI trade. It may or may not be a coincidence that ChatGPT was released in October 22, which, by the way, was when the current bull market started. Some of the initial bounce was just that we were oversold, but I think that the ensuing rally is very much predicated on artificial intelligence. And I point back to a piece that I wrote in, I think it was February of 23, where I counted the number of times that Jensen Huang or one of the other NVIDIA management on their earnings call used the term artificial intelligence or AI. Memory doesn't serve me all that well. I think it was 57 times before the first question. So it's pretty clear that's been the mode. And there's been all this spending. You've got billions and billions of dollars in spending. It's almost like a race to see whether Microsoft can spend more than Alphabet or can spend more than Amazon or Meta. Meta seems to be winning that race in terms of who can spend the most money. But I think it's all sort of self-reinforcing. NVIDIA sells to the other 6 Mag 7 members. And any sort of sign that this is slowing down, or even just that the pace of growth is not exponential anymore, that it might be something linear, that weighs on the whole market. And the reason it weighs on the whole market partially is because of the concentration. When you have Mag 7 plus Broadcom, I don't know, grade 8, whatever you want to call it, being roughly a third of the S&P 500, we'll call it half of the NASDAQ 100, if these stocks fade, there's not a lot of room to hide. We are seeing some rotation. The advanced declines on a lot of these sell-offs are not actually all that terrible. They're not those 3-to-1, 4-to-1, 5-to-1 kind of days. So there is some rotation going on, but it's a bit tepid, not enough to offset what just could be some tiredness in these big cap tech stocks.
Steve Sears, I want to take you back to a little chapter, a vignette I remember from your book of, I think, 2012, The Indomitable Investor, in which you described the struggle, I think it was a couple from Brooklyn in New York had, in trying to fire their broker who was managing their money at the time during the great financial crisis. And they managed to do is they liquidated everything, and I think even they sold the house, whatever. It played out well for them at the time, but the question I have then is there ever a time for investors to sit out the market?
I think that's a great question. I think the answer to it is yes. I think people should be fully invested at all times, but we seem to be living in an era in which people think they must be in perpetual motion and perpetually chasing the hottest stock. The thing that strikes me as so interesting, and then this underscores sentiment and the moves we're seeing in the marketplace, is that for the first time that I can recall, the volume and interest in upside options on NVIDIA and any of these, any name you want to pick, oftentimes dwarfs that of this actual stock. So what happens is you get into an event, everybody thinks I'm going to buy calls on it. They have no idea actually how to price the call. They're used to the stock making a huge move, but when the stock does not make a huge move, as was the case with NVIDIA, for instance, all the options guys freak out. That creates all sorts of havoc within the trading ecosystem and it drags the stock down. Now, I don't believe that type of geist in the moment is the reason to sell. And that couple that I referenced in my book happened to have taken action around the global financial crisis. So they actually timed it pretty well. And I understand afterwards they got in March of '09 and wrote the thing right back up and 100%, and they are still invested. So I think now when you're seeing these things dance about, the other point to consider is that there is sentiment and there's trading volume and there's that sort of go mentality. But at the same time, if you speak to institutional investors, they'll quickly tell you they're dismissive of that type of short-term activity. And in fact, earnings are growing. Last week, earnings were increased for NVIDIA, Broadcom, one other big cap stock that I can't remember. And the research that went out from Goldman to clients this morning, or over the weekend rather, was that for the first time since some late 2004, forward earnings have increased. And if you speak to institutional investors, perhaps not people who focus on derivatives as much as we do, but pure stock, slow money guys, they tell you, you invest to buy growing earnings, and earnings are growing. And I think that it's incumbent upon investors to now make a differentiation between short-term momentum and trading volatility and the go nature of the current options market versus what is actually taking place in these really boring, not exciting things to discuss, such as earnings and price multiples and revenue growth.
To build on that point, though, this is where you have to think about the difference between investing and speculation. Right now, you are getting paid to wait for the first time in decades, which everybody's complaining the rates are too high. But honestly, through most of, let's say, the 90s, you were talking about rates in the fives, not the fours. So it's not necessarily too high, and you can get paid to sit on the sidelines if you feel better about it. I think the bigger risk, though, is how much people are willing to just buy the dips no matter what. I'm looking, as I've noted before, I have very limited insight into what our customers are doing, but that's for everybody's protection. But I do see what our top 25 most active names are on a rolling 1 week basis. 24 of them, as of Friday, as of the date I saw this morning, which is through Friday, 24 of them were all net to the buy side on the stock side. And guess what had the biggest buy interests? NVIDIA, NVIDIA, Tesla, Palantir. So at some point, I've written about this recently, you have to decide if buying a dip is catching a falling knife. And that's really the issue here. And that goes into, are you investing or are you trading? Are you seeing that these things are new values, or are you just seeing reflexively because it's worked so well for so long that if stock A is down, then by X%, then therefore buy more? And that, because not every dip is a buying opportunity. And quite frankly, there are times where the trend changes and you really want to be more aggressive at selling rallies than you do about buying dips. I
I th-
don't know that we're there yet. I think to Steve's earlier point, there's a little bit of arm wrestling going on as to whether the trend has changed or not. I think neither side, the Bulls nor the Bears, are in true control right now. I do want to get the point across that we see a lot of buying the dip activity, and I'm getting the sense it's more just reflexive. And we see it every morning. Unfortunately, we weren't rolling the tape when we were talking about this earlier, but I think it's time to bring up the conversation again. How many mornings would you say? I don't have the number in front of me, but it seems that every morning the SPOs are up 20 or 25 points when the market opens, right? It's just reflexive. I'll wake up, sort of see the SPOs up, like they could be flat, they could be even, they might be up 5 or 10 points, but pretty much uniformly by about 9 o'clock, they're up 20 or 25 points. And that again is just doing this trade because doing something because it's worked. But because something's worked doesn't mean it continues to work. That's something I think we have to be very concerned about in terms of trader behavior as opposed maybe to investor behavior.
I think to build upon Steve's point, this buy the dip mentality is probably the greatest risk factor facing the market, and it's existed for quite some time. And even at the institutional levels, there's all kinds of charts circulating showing the S&P in its channel as these guys are playing the dips. At some point, the thing is going to break. It always does. I obviously don't know when it's going to occur, but for now, it seems to be stuck in a very vicious range. Each morning, as Steve says, you can see the SPOs are higher. And at the same time, I've been hearing now for the past 2 months how the institutional community is shorting U.S. equities via the funding markets, the S&P 500 futures and others. And that is starting to burn off. And we saw that on Friday, which was a parabolic move higher in US equities. I think the Dow was up 600 points after having been weak. But today, the old sort of realities assert themselves. The ISM report came out, new orders, which is the guts of the index, was indicated a contraction. And so we're selling stocks and we're going back and forth in this sort of range. Sooner or later, it's going to give. What is the key catalyst? I would say it's the president, much more so than anything else that we're used to analyzing and pushing off of.
That's my last question, really. I'm going to throw this one to Steve Sosnick. And Steve Sears, please feel free to chime in afterwards. Donald Trump has got a proven track record, has he not, Steve, of controlling the narrative, but can he control the impact of the narrative at the end of the day?
They're both difficult to control. I will say that the president is, as you say, is a master of controlling narrative and controlling the news flow and controlling the news cycle. But it does tend to be all about results. And I think right now we've been high on drama, certainly, and there have been plenty of very consequential things that have occurred regarding the current administration, but they're not market specific right now. And ultimately, turning around the economy is like turning around a battleship, and we're an aircraft carrier. It takes time. It's difficult to do. Unfortunately, today, as Steve alluded to, this was the latest in a series of potentially stagflationary economic reports. ISM is not necessarily the biggie, but we've seen prices paid continue to rise across a wide range
Mm.
of indicators. We've seen consumer sentiment stink remember, we had two in a row bad Michigan numbers and higher inflationary expectations. And then retail sales was terrible. And then Walmart told you that things are not going so well with their customers. And that's even before any tariffs are coming into place. So we're in a we're in a more fragile situation than I think a lot of us want to recognize. And if that is true, the president, no matter how good he is at controlling the narrative or even being able to jawbone the economy, it ends up being a very difficult thing to manage. And I think that's why I get asked the question all the time, why did the Trump rally fade? You alluded to it earlier today. And it's the difficulty in that. I think the vibes are difficult. Ultimately, I still think with what's going on, a lot of people still worrying about what's going on with the price of eggs. And that's really not in the president's control on a day-to-day basis.
I agree with Steve. But if the president comes out and says, I'm going to lower income taxes by X percent, or I am going to do something that everybody understands will put money in their wallet, the market's going to surge in response to it. Now, the great question is, at what point will the street start to analyze the impact of it, i.e., is it inflation, is it stagflation? I really don't know. But I think the guy is a genius at narrative, and you can never underestimate the awesome power of the presidency of the United States. The street will do this, what the street does, and until it doesn't. But I think, to quote President Reagan, who I believe came up with the Make America Great Again motto initially, we're in a trust but verify mode. And the street wants to trust him and they're looking for verification. And should the president give them something to verify and mark his policies to market, it's going to be higher for the indexes and lower for options vol.
Reagan, by the way, did coin the phrase. I have a picture from my friend who collects Americana, has a campaign poster from Reagan saying, let's make America great again. But yes, it was in fact Reagan. But just to your point about income taxes, it depends. If it's a very top heavy income tax cuts, I think the bond market freaks out without the public getting too excited. I think if it's one of these that affects everybody's pocketbook, then you might get a bit of a turn. I think right now, the bond market has been quite cooperative, but I think that's more because they're concerned
Mm.
about the economic message and the potential for an economic slowdown leading to interest rate cuts, which my concern is they may not come in time. But
I'm sorry to interrupt. I heard something fascinating at a real estate conference actually 2 weeks ago. They were talking about the funding markets and how spreads have come in and they've normalized. And that even though rates have not returned to their sub 4% level, the markets are acting, the bond markets, the lending markets are acting as if business conditions are really good, which is giving the central bank plenty of time to, to figure things out or to let rates be at this more normal level.
That's interesting because one of my contentions is I was at a conference recently where I was on a panel with another strategist and an economist, and their assertion was that, and it's not wrong, that they were going along with the Fed's idea that the rate regime is relatively tight, restrictive, and their argument, which is
Not.
fair, is that from a real rate point of view, they're relatively elevated. Now, again, I'll argue historically, long term historically, we're not that elevated, but short term history, yes, we're quite elevated. Therefore, we're somewhat restrictive. On the other hand, what in the real world is telling us that things are restrictive? It's
Can't
certainly
find
not
it.
credit spreads. It's certainly not enthusiasm in the stock market. It's certainly not risk assets. The recent dip in crypto, notwithstanding, which reversed a certain amount after the president's comments about the strategic crypto reserve. But ultimately, there is plenty of money sloshing around doing risky things. And therefore, that is telling me that from a on the ground point of view, it's not that restrictive. And
But
that's what
not always risky.
no, but that's what made 24 such a great market environment because we had a good economy. There was a lot of stimulus, which is getting withdrawn pretty quickly. But we have the G and GDP go up, the government part of it. That's gone in retrograde. But in general, the economy is still humming along quite well. It isn't all risk, but in 24, you had a strong economy and improving inflation and a Fed that was willing to cut rates. That's nirvana for a stock market. It's hard to imagine all those conditions being in place in 2025, which doesn't mean head for the exits, but it does mean maybe you don't want to just put your blinders on and just buy everything all the time just because you see an opportunity
Well,
because there's a slight dip.
I've got to tell you, if you're comfortable with puts and calls, I can't think of a better time to trade puts and calls on these names. It's a true trading market. That said, the one thing that I find myself thinking about a lot is what if they're playing a different game than we're used to? And what if this idea of the strategic crypto reserve has much broader policy implications and changes embedded in it that have been discussed or than we've contemplated? For instance, could we ever see a time when the 10-year and US government debt is not as important and maybe Bitcoin becomes more important?
Scott Bessent just told us that they're focused on the 10-year, not the stock market, let alone crypto. I'm not dismissing this. Maybe there is some sort of three-dimensional chess going on or four-dimensional chess that we're not picking up on, and that's entirely possible. But part of the reason for the market rally was everybody expected that this administration would be focused on the stock market. And meanwhile, you had the Treasury Secretary come out and go, not so fast. We're going to focus on the
But the
bond market.
Treasury Secretary may not have gotten the memo.
Possible. Yeah, it's possible. Hard
I
to
think,
imagine, but possible.
but I was also hard for me to imagine that a guy who managed $1 billion, which is by no means a large hedge fund, would be tapped for Treasury. Trump's cabinet secretaries largely seem to be guys and girls who carry his wood and water. And Trump thinks about what he does and then he tells them what to do
Mm,
or
mm.
fires them.
Which to some extent is why Besant is where he is, because he was one of the more vocal Wall Street people. And him and Howard Lutnick were two of the most vocal Wall Street people, not necessarily the biggest funders, but certainly the most vocal. And that is to a large extent why they're in the prominent positions that they're in right now. But I do find it hard to believe. Yes, the policies, the rug could easily shift under them. The whole tectonics of what's going on could change because the president is known to be fairly mercurial. But I think as of now, the fact to say that the Treasury Secretary hasn't gotten the memo, that might be a bit of a stretch.
I'll stick by it. It's not a stretch at all. And it's just something that I find myself thinking about. And if you think about what could be one of the greatest ways to put your name down in history, it would be to create an international currency. And I think that Trump is probably thinking that way. And I think that poses a potential shift. We're not there yet. Obviously, it's trust but verify still, but it's just something I find myself thinking about.
Are we talking about not the next one, but certainly in the future, 10-year issuance in Bitcoin?
Stranger things have happened, and you have the background in that.
The thing is, they can actually have the strategic crypto reserve without actually doing anything because there's, I think, $17 billion in seized crypto that's sitting on the Treasury's balance sheet. So there's your reserve right now. And so in many ways, rhetoric could be such to mollify the crypto community, which was very strong backers of Trump's campaign. Because ultimately, again, how much of our tax dollars are going to be spent to just buy risky assets That's not necessarily fitting with a government that's into austerity. On the other hand, if you say, okay, we've got $17 billion, we may add or subtract from it. Maybe we do monetize it. The reserve may be in place, which is why, as we're speaking, on again, Monday the 3rd, Bitcoin's actually dipped down back below 90,000, literally while we're on this call. So I
But
think
if
some of the crypto enthusiasm may have faded because that may be what the government ends up doing.
I think a lot of the daily peregrinations of Bitcoin and anything else reflects this whole trading activity. And I remember being told years ago that LIBOR was preferred to our US interest rates because it was thought to be less subject to political manipulation. And of course, we all know what happened with LIBOR. Now, if you set up something with Bitcoin or crypto, who knows? I'm really just going slightly out on a trust but verify tangent, but it's just something I keep thinking about because I don't think that we in the markets have a true angle on what Trump's ultimate game is. I think if anything, he's made volatility great again and that's about it.
I was literally going to
Right?
say that. You were
Right?
leading right into that, and I was like, "Okay, there we go." I had it teed up.
And just trade it, own it, and
Yeah,
own stocks, trade volatility, and just see
yeah,
what happens. I
yeah.
think we're on the cusp of a new opportunistic era.
Brilliant. Thank you to both my guests today, Steve Sears, columnist at Barron's, author of The Striking Price, and Steve Sosnick, chief market strategist at Interactive Brokers. Thanks to you both, gentlemen.
Thank you
Thank
so
you.
much, guys. Take care.
And
Great.
don't forget, if you enjoyed today's edition, don't forget to subscribe wherever you download your podcast from. Bye for now.
The analysis in this material is provided for information only and is not and should not be construed as an offer to sell or the solicitation of an offer to buy any security. To the extent that this material discusses general market activity, industry, or sector trends, or other broad-based economic or political conditions, it should not be construed as research or investment advice. To the extent that it includes references to specific securities, commodities, currencies, or other instruments, those references do not constitute a recommendation by IBKR to buy, sell, or hold such investments. This material does not and is not intended to take into account the particular financial conditions, investment objectives, or requirements of individual customers. Before acting on this material, you should consider whether it is suitable for your particular circumstances, and, as necessary, seek professional advice. Options involve risk and are not suitable for all investors. For more information, read the characteristics and risks of standardized options, or OD, which may be accessed through the link found in the podcast description page. Trading in digital assets, including cryptocurrencies, is especially risky and is only for individuals with a high risk tolerance and the financial ability to sustain losses. Eligibility to trade in digital asset products may vary based on jurisdiction.